how can we get better deals than 99% of people every single time we trade? And because of that, by default, our default is going to be profitable, whereas the default of other people is not going to be profitable. Just looking at the scalper here, looking pretty good. Just, you know, just working as always, especially now in a range after the big drop. It's just gonna work really well. It's at an all-time high right now. So yeah, always good to just check it out every once in a while. All right, so here's what we're going to cover today. So how do we, and we'll base it off of two strategies, but how do we make sure that we get the best deal on every single trade that we trade, and not trade bad deals, only trade good deals, and be in the green like 90% of the time of the trade? That's what we want to focus on. And I'll do it as an example on, say, the 50 and 30 minute. And we'll do it with two different strategies. We'll do it with a trend reversal and a trend following strategy. So here's the point. Why do we want to talk about this? Well, let's go to a range here. And let's say that there's this, I have covered this before, so let me just repeat it real quick. So let's say that there's two people trading this, right? And let me see. Let's go with something like this. Good example here. So let's say that we're trading this. So our stochastic topped out here, right? We just established the range here. Let me draw it real quick. We just established the range here. And now we just touch this range right here. So, and our stochastic stopped out. So let's just assume, I'm not gonna, validate this trade. Let's just assume that we're gonna enter this trade. And we wanna short this, right? So there's one person that is gonna look at this trade as, we should, and trade it the correct way, and there's going to be a person that's going to trade it the retail way, right? So let's assume that we are getting after here, somewhere here, we're going to get a sell signal. So what are we going to look at? Well, first of all, we're at the top of the range. That's good. Our stochastic's topped out. That's good, right? We had a pretty big wick here, and the price is starting to go down. So what do? As always, we're towards the top of the range, yes. However, we know the fact that when there is a lower move to the downside, the bigger move to the downside, or any move to the downside, very often, before that, we're grabbing liquidity, right? So when we're grabbing liquidity, you do that by trying to get stop losses. So especially here where, this looks like a really, really clean line here, chances are even higher that we're going to hit some stop losses, hunt for some stop losses before we move further down. So in that case, what we got to do is we have to layer in our trade. So let's assume that we have our trade here, right? And you could say like, oh wow, I have a great entry now. I can put my stop loss just above this level, and here we go. Let's short down with the target being here. Well, yeah. However, when you look a little bit further back, there's actually quite a bit of levels just above that where the chance is pretty high that we're gonna hit this. It doesn't have to happen, but the chance is pretty high that we're gonna hit this, high enough where we need to account for it. So what are we gonna do instead? We're gonna do a trade where we will look at the bottom of the range, we'll look at the top of the range, we enter a small amount here, and then we layer in, right? So we layer a couple of trades here, and then at every support or resistance level, we can layer in more, and then at just above where we put our stop loss, then we just put an extra order there. So this is just how we do this. So how is this going to work out, right? So let's say we have two people here that are trading. Person number one just shorted 100% and put their stop loss here. Person number two just did what we said. So the price is going in our direction, which is great, and then it suddenly turns around. As it suddenly turns around, we, based on our analysis, still assume that the price can go further down. Let's just assume that 31.2 are still strictly going down, and we're well within our trade. So let me just put two trades next to each other so we can see how they play out. So trade number one is going to be the bad trade, and trade number two is going to be the good trade. Same setup, right? Same setup. So what's going to happen now is, as the price will start going against us. So we're positive, and then suddenly we're negative, right? The price will start going against us. What happens on the good trade? On the good trade, we hit a entry, right? So our average entry just goes a little bit higher. We hit another entry, our average entry just moves a little bit higher. We hit another entry, and our average entry just moves a little bit higher. We hit another entry, and our entry moves a little bit higher. So this person, the first person that just entered, and that's it. Well, he just had to endure a minus 1% spot. So let's assume they're trading 20% or 20x or something like that. So minus 20% on their trade. Just had to endure it for 4 hours. Had to endure a minus 20% drawdown, plus or minus, depending on when, and had to stare at it as the price goes up and they go more and more into a loss. As opposed to the other person that just keeps entering and keeps hitting their layers. At the end of the day, once we hit those layers, our average entry is somewhere around here. Now, what will this do? Well, first of all, the second we start going back down to the range, we're profitable. So just after we hit our layers and we started going back down, we started being profitable. And the time where we were unprofitable was actually only 1 hour, whereas the other guy, it was 4 hours. That's number one. Number two is, obviously, we have a much higher average entry. What does that mean? That means that we have a larger space now to hit our take profit, and the amount that we risk has a bigger value for its buck, because the area that we're risking is much, much smaller. What does that mean? If assuming both risk 10% of their account, say both risk $1,000, right? Both risk $1,000. However, this one needs to cover 1.3% with that $1,000, whereas we need to only cover 0.8% with that $1,000, which means that we can enter more, which means that, once again, because we can enter more, we have a bigger profit, and then once again we have extra area for the profit. So it's a double multiple, right? So that's one thing. The next thing is the fact that as the trade goes on, assuming we just stay in, as the trade goes on, the guy with the bad trade, he was very, very negative. And then he became just about profitable, chopped around his profit, and then went negative again, and then started being positive. Well, what could have happened, what probably happened with the first guy was, first of all, he got stopped out here right away. For some reason, if he would, in the last second, remove his stop loss or something like that, he would just be very much in the red, come back, be happy about it, maybe put his stop loss back up or something like that, and then be in the red again. So this guy had to endure pretty much on and off 14 hours of red, which means that, if you're in a market and you're red in the market, it means that if something happened and you had to get the money out right now, you're negative, right? So, and the longer you're exposed in the market, obviously, the higher the chance that, you will be at a loss. Whereas the longer you're positive in the market, the higher the chance that you're exit at a profit. So this guy had 14 hours of drawdown, whereas this guy had 1 hour of drawdown and was never negative again. And as the first guy, the bad guy, let's just call him Joe, as Joe was fighting for break even, let's call this one Mark. Mark was up 0.5% on spot, so 10% on 20x, right? So whereas someone's fighting for break even and just about sees the number jumping between green and red, just about, after enduring 4 hours of losses, Mark is up 10% and never gets into a drawdown again in the entire trade. This is the only drawdown that they have in that trade. Whereas Joe is more red than green. So, like we talked about yesterday, extrapolating this over 1,000 trades, who's gonna end up winning? Of course, Mark, because Joe is, underwater 50% of the time. So obviously, over the period of 1,000 trades, a lot more stuff will happen to Joe that's very unpleasant than to Mark. So that's why when we anticipate where the price is going to go, we anticipate and understand the strategy, and then layer in our trades, we get a much, much better deal. This trade didn't even hit the bottom of the range. However, with Mark, he was up 1.5% on, so 30% on 20x on his maximum. Whereas Joe was, first of all, in drawdown 14 hours of the trade, which is absolutely horrendous, and was only up 20% at maximum. However, Joe was also down 20%, and Mark was down 0.5%. So that's so under 10%. So, and that's the difference. And imagine trading like this every single trade that you trade. That's why we want to make sure that we anticipate our trades, and we make sure that when we enter at a good deal. Because number one, we risk less. Number two, we're exposed for a smaller amount of time in the market. And number three, we have this amazing double benefit of when we trade. Let's just assume this long. So let's just put our stop loss here for visualization purposes. So let's put our stop loss here, and let's say we enter here or here. So as we enter here, right, we have a 1.7 risk to reward. We're risking, 1%, so we're just scaling this. We will 10x this trade, so we risk 10% of our account. And we can get back 16% of our account, 17% of our account, right? So we'll 10x this. I'm going with $1,000, 10x. So the most we can lose is $100, and the most we can gain is $170, right? And we're 10x. Let's assume you get an entry here. Let's just assume, right? Okay, well now our risk reward is 8. And we have a 0.3%. So we can actually go in with 30x. Not just 10x, we can go in with 30x. So now here, you entered $1,000 10x, so effectively you're trading $10,000. Here, for the same risk amount, you can enter with $1,000 30x, so you're trading with $30,000. So you're trading with $30,000 with the same risk, which obviously means that the profit's bigger. But that's not all, because here you're trading 1.6% with $10,000, which could make you 16%, right? However, here you're trading 2.4% with $30,000. So the profit percentage increased from 1.6 to 2.4, and your leverage increased by a multiple of 3. So you have a double effect here, because you can trade with more money because you're risking the area that you need to cover with your risk is much smaller, so you can trade with more, right, for the same amount of risk, and the amount of profit that you get is a larger area plus or multiplied by the extra leverage that you get, right? So this is 2x on 30x. So this gets you 60% or more, actually, like 72 or something like that. Whereas this one got you 16%. So we're risking $1,000 and we can make 1.6. We're risking $100 and we can make $160 when we enter it with $1,000 on 10x. Here, we risk $100, but we can make like $720. It's the same trade, but it's a different entry. And how do we make sure that we get an entry like this? Well, it's not, it's not staring at the chart and clicking the buy button right here. That's not how you do that, right? Because you'll never be able to hit the exact bottom. But you can play probabilities, meaning that you can recognize the trade, same as the first person, you can recognize the trade here. However, instead of fully entering, what you do, obviously here, right, the bottom of the range is down, lower, and before a big move happens, usually you go even lower, right? So assuming that the bottom of the range is here, then, first of all, most people will have their stop loss right here. So this is where my biggest order is going to be, right? Where people put the stop loss, we enter. And our stop loss is lower than this. And we can probably have one more order here just to hit these levels. So we go up, and, just to fake people out, and then we go back down, and our average entry goes from, maybe I can move it, our average entry goes from here to here, something like this. So now we scale the risk that we have to assuming that we want to risk 10% of the account. And we just increased by a lot, by a big margin. We increased the area that we're profiting, and we increased the leverage that we can trade with, and those multiply together. So instead of $160 with $100 risking, we can make $720 with $100 risking. That's a big difference. That's a really big difference. And now let's think about these two scenarios and extrapolate it over 1,000 trades. It's a nuclear difference. It's completely like the performance from those two accounts, assuming the one traded $160 here and the other one traded $720 here. The difference between those is astronomical because they're compounding too. It's not even close to the same, it's not even the same trading. That's how big the difference is. It's in the thousands of X's and multiples. So that's why it's so important, right? Making sure that you get a good deal every single time. And the beautiful part is that even small improvements compound a lot over time, because every single beneficial thing that you do gets essentially saved in the memory, because that's what you profit off of, and then your next trade can work with that benefit already, because that extra profit now can make you extra profit, right? That's what compounding is. So when you improve your performance by a substantial amount like this, you're trading the same things. This was the same signal. It's the same strategy, it's the same signal. but it's completely different risk management, right? So the one best case scenario can make $160. The other one best case scenario can make $720. Well, that difference is so substantial that it does not even compare over 1,000 trades. So that's a huge benefit that you can do. And when even small changes, when even small additions that help, are big differences over 1,000 trades. Imagine the huge difference that this is going to make when it's such a big improvement, right? And this is like, you can take a half decent strategy or like an average strategy, and just by trading it this way, just by anticipating what the market's going to do, and because of that get rewarded by having really good entries, what that's going to do is it will make that half decent strategy like absolutely profitable. And this is something that we've been dealing with, and if you're building strategies, you probably came across this, which is that when you backtest a strategy and you have entries and exits and so on, you might be like, okay, well, but that might not be realistic because I might never get this price when I'm actually live trading it. And yeah, that's true. If you're chasing the price and you get a signal, and then the signal needs to be processed, and then when a signal gets processed, then an order, a market or limit order gets hit, then yeah, it might not get hit, and you might enter with a much worse price, and then the backtest that you did is completely irrelevant because those prices are actually not right. And when you backtested with accounting for that, you figure out that your strategy is actually really bad. So yeah, that's a thing. However, if you're trading ranges and it is simple to mathematically anticipate where the ranges are, well, then you can set those orders before that happens, or whenever a signal happens, you can just add in orders, like layers of orders below the price, when you're anticipating or when you've analyzed the fact that sometimes the price goes against you. And if it does, you turn an unfortunate event, right, a negative event of the price going against you, which is something that you don't want, well, you turn that into something very positive because now you're just getting a better and better and better entry. Assuming that obviously the strategy is valid. A great example actually is going to be one of our dashboard strategies. I love this website, by the way. Moonwalk, you did a great job. I think that this is going to be probably the turtle. Let's just check the turtle and let's see. I'm waiting for the description of the turtle. Let's just have it load a little bit. But that strategy, it's trading, in a higher time frame, on a 4-hour plus. So the trades are a bit longer. And this is the most profitable strategy, like single strategy, not within a bundle, that we have. I think it made over 22,000% over 2 years or something like that of actual trading data. So 2,200%, sorry. So yeah, and this is the strategy. It's a very, very profitable strategy. However, it did 22x, right, over 2 years. So on spot, without any leverage. So when we look at this, when we look at the stats, the average drawdown within a trade. So this is a strategy that made 22x in 2 years. And right now it's more. This is just when we were writing the descriptions. Right now it made more. Like that data isn't even there. If we put in the data further back, then it would be in the, I don't know, 40x, 80x, I don't know. We'll see. I don't remember. I can just add it in. So this is a strategy with an 80% hit rate, which is super high hit rate, 3.2 Sharpe ratio, which is insane, average profit of 13%, and 2,200% in 2 years. It's a very, very good strategy. the average drawdown in that strategy is 8%. What does this mean? Well, what it means is that when we get a signal, then on average, the price is still going to go against us by 8% before we continue into our direction and get into profits and you know, make a lot of profits. But on average, we have a drawdown of 8%. And this is a normal strategy. And you know, these strategies, to be clear, they could technically be optimized more, but that's not the point of them, because the point of them is that the strategies can just run the way they are right now, and they can just, without, you know, any human intervention, they can just keep running for years to come without us having to tweak anything. So that's the point, right? That's why the drawdown's there. But there's an 8% drawdown before we continue going up, right? And you can see that actually very often. Whenever you have a good trade, right? So here, this was a big long. We had a drawdown before we moved further up. Here, we had, you know, some kind of drawdown. There's going to be some more trades, probably on Solana as well. Let me check that one out. But they're drawdowns before we have a further move up. So in those drawdowns, you can say, okay, well, we can just, you know, try to estimate the best time or the number of candles or something like that to somehow pinpoint the absolute bottom of the price. You don't need to do that. You can just cast the net and see where the price goes, and based on that, it will hit your orders, and you will get your average order, average entry at pretty much the best price you can have. And then you have a huge profit, and you can trade with more money with a higher leverage. So you have your double profit here, which is a huge benefit. And this is what a good deal is, right? So this is also when we were talking about Bitcoin before this big move down, right? We anticipated a trade here. I have a lot of lines here. Let me try and just get rid of them. Move the drawings. Okay, here we go. So we were anticipating this move down, right? And where we anticipated it was actually right here, where we moved further down. And if you guys remember what I said was, okay, we're at the bottom of the range, right? I would not like to short at the bottom of the range because the chance that we will bounce is very high. And bounce we did, right? So what I said was, okay, well, I would just layer orders in to the upside, and then whatever orders get hit, that's good. And whenever the move to the downside happens, we will have the best possible entry possible. And the reason we want to do that is because if the price does not go down, or if the price chops around more, we will end up being profitable most of the time. And if we're not, we're just adding into our trades in order to be profitable later on. And then it's also a big multiple over how much we can trade, because if we have to risk much less, we can enter with much more, and that's a complete multiplier on, you know, the move that will happen. So if this is a big move, then, you know, risking half as little, meaning that you can enter with twice as much, literally doubles your profits. So that's the important part here. We anticipate where price is going to go. Okay, we're range trading here. We're in a range. We're at the bottom of the range. We know that, you know, the market likes to like shake out weak hands, right? So instead of just going 100% in here and then just hoping at the bottom of the range, by the way, and just hoping that, you know, the price doesn't go to the top of the range, which, by the way, it's designed to do, right? That's a core market principle that we're bouncing in a range. So we're literally betting against a core market principle if we just short here without any thinking. If we short here with, say, 10% and we start layering orders towards the top of the range, well, now that makes sense. And whatever we hit, right, we hit, and then we have our move down, and then our entry has, is close to the best possible entry you could possibly have here. Another good entry would be here, which is something that we didn't catch at that time. Here, same thing, trying to long the bottom of the range, right? Makes great sense here. And you can do that, like, it goes so far as that. This is a secret tip that you guys can trade. When I see that the stochastics are fully aligned with the price, meaning that the tops are at the top, the bottoms are at the bottom, and it just has the right flow with it, what I do, and I see the range, right? And I see it ranging over multiple time frames. What I do is I set up sell orders here, I set up buy orders here, and then I just let them play out. And literally, very often it happens where you just hit sell, goes to buy, goes to sell, goes to buy. And I just replenish the orders every time. And before we break out, we probably have like 4 or 5 or 6 touches where I make profit on every single one of those moves. It's literally delivering a package from top to bottom, top to bottom, top to bottom. And all of those trades, we have the best possible entries we can have. So if someone would, like, without any logical reasoning, if someone would just look at the history of the account, they would be like, how is it possible that they can trade with such a precision and always get the best possible entries and best possible prices? Like, they have to be like insider trading or something like that. It's quite the opposite of it. It's literally just setting up the orders and like going out for lunch. That's literally what it is, right? It's just the right information, just understanding the fundamentals of the market is what will give you a huge, huge advantage. Where to the extent where people don't even understand how you could, perform this miracle, where it's like, it's absolutely nothing that's crazy about this. It's not rocket science. This is the simplest form of logic there is, right? There's a rule that's being followed in the market, and you just trade on that rule, and you'll be right until you're wrong, right? You know that you'll be wrong at some point, because by definition it is guaranteed that the price will break out of the range, either to the upside or downside at some point. So all you're going to try and do is trade the range, and manage the trade when it breaks against you. How do you do that? Well, by setting your invalidation zones. So you're going to have your risk to reward, by the way, is very, very good. So you're going to have like 5 or 6 rewards and 1 risk that will be hit. And that's it. And you can do this all day. Or not all day, but, a lot. So, on a lot of charts too. So that's why I really, really like range trading, because it's so predictable. And when trading, that's exactly what we want. We want predictable trades. And how do we make the best of it? Well, because it's predictable, because of the fact that it's predictable, we get an advantage of being able to guess where the price is going to go and being right most of the time, which is something that people try to do in the market all the time, right? Well, in ranges it's actually much easier to do. People don't take advantage of that. So when you do it in a range, and there's also different indicators that will tell you, are we in a range, are we staying in a range, what's the likelihood of staying in a range? Well, likelihood, like I can tell you right now, how can we anticipate that we'll break out of the range? So what we did yesterday, like when we have some alignments on the higher time frames and it starts, aligning towards the lower time frames, that's basically like a progress bar for you to see, okay, well, now we might actually break out of the range. But in general, I mean, that's what you're gonna see, right? You have in the range, you're bouncing from top to bottom, and you can just literally transfer packets from top to bottom. However, you do that in a smart way. Number one, you have a great risk to reward, right? So your entries are very close to the best possible entries that you can have. And number two is you have a clear invalidation zone of when you will exit in a loss, in case with your stop loss, in case there's a breakout. However, when doing that, you still understand the fact that the price can, there are stop loss hunts. So wherever you would put your stop loss on first sight, put a buy order there or an entry order there and put your stop loss below that. And just following these simple rules, you'll be outperforming like 98% of traders. It's very, very simple, logical things. It's not rocket science, but people just don't follow it. So, yep, that is it. That's what I wanted to cover today, actually. Okay, what indicators tell you if your range is breaking out? A few actually combinations. So number one is what I just said. You have multiple different time frames, right? And based on those time frames, based on the stochastics, you will see, okay, is a momentum starting to form, right? And as a momentum is starting to form on the higher time frames, like you see the start to going down, then candle by candle, the chance is higher that you will break out. So let's assume here, for example, let's assume that like our 1, 2, 3, 4, 5, 6, 8, like 1, 2, 3, 4, I'm pretty sure that they were completely topped out. The 1 hour started going down, the 30 minutes started going down, the 2 hour was, very flat at the top. And because our lower time frames, our 2 hour will start going down as well by definition, which will start moving these time frames to the downside, right? So we have a bearish alignment on the higher time frames. On the lower time frames, we were all over the place. However, this means, by definition, we cannot say exactly when we're going to break out. But we see that the breakout's probably going to be to the downside because we have a really, really good alignment on the higher time frames, which means that the shorts, whenever a short alignment happens on the lower time frames, that has a much, much higher validity than a long signal. Because a short signal, what you're going to do is there's a chance that with your short signal, there will be the breakout, right? So there's a huge possibility for a payday on every single short. And the more shorts you have like that, with the alignments just starting to go further and further down, being more and more bearish, the more probability-wise, the more heavier, not heavy you should go on a short, but the more attractive the short is. Whereas the more of a strong alignment you have bearish, the less attractive a long is. So at that point, I would not long at all. All I would do is I would layer in my shorts, and the stronger the alignments to the downside, the lower I would start layering my orders. And as we're just chopping around here, well, what this means is that here we topped out, right? And then we just started chopping around, nothing happened. And here we topped out again on the 15-minute. However, the price is very, very far from the top of the range, right? So that's a very bearish sign already. Then we topped out again, not breaking this range, not even going close to the top of the range, which means that, okay, well, there's a lot of pressure pushing down, the stochastics topping out, but the range is not at the top. So, that's essentially our divergence, and then we start breaking to the downside. So that's number one, looking at the stochastics on different time frames and aligning them together. And the other thing is a rate of change, ROC, which is also a good indicator to check, okay, what is the volatility right now? And lower volatility means that we're not breaking out. Higher volatility means that we're going from range to range. So that's one thing. So, and that's what we're using in our strategies, is multiple time frame stochastics and ROC. Another thing that's actually really good to look at, which is something that we have not really used in our strategies and algorithms, but it's something that we have been looking at, and that has been recommended by us, by our investor, who was like 50 years on Wall Street and is a billionaire, which is implied volatility. So there's an index both for Bitcoin and Ethereum, and any other forex or whatever, which is implied volatility, which is an index where people bet what the volatility is going to be on Bitcoin and Ethereum. So humans, people, are trying to estimate the volatility that will happen. So if the implied volatility were start going down, so for example, me, right? I'm trading and I see, okay, well, my stochastics are, starting to align to the downside. 20 other traders have 20 other strategies where they start, okay, they start the breakout, it's starting to come soon, right? So what they do then is they trade the index of the implied volatility, or they short it, or they secure it, they hedge with it, whatever, and they bet on the fact that the volatility is gonna go down because they know, or they think they have an edge over the market, that the volatility at some point is gonna go down, and we're getting closer and closer to it. So the index, the implied volatility index, will start rising, which then you can take, right, as a piece of information and trade based off that. Implied volatility index BTC. This one. I think it's this one. I haven't. There we go. Right. So here's the implied volatility, right? So this is an index where people bet on the volatility that's most likely to happen, right? So as the volatility goes down, we're in a range. As the volatility goes up, we're starting to be obviously more volatile. So yeah, that's definitely something that you guys can look at, and you guys can play around with. So yeah, that's all I wanted to cover today. If you guys have any other questions, let me know. But yeah, this is, I hope I explain it in a logical way why getting good deals on trades is that important, because it minimizes your risk, it maximizes your profit, and then it multiplies that maximizing of profit by another maximizing of profit, right? Because you're trading with more and you have more area to trade with. And extrapolating that over 1,000 trades is, you cannot even compare the accounts. So whenever you're trading, understand the strategy and see, okay, well, are we range trading? Then obviously it's kind of easy to anticipate. Also, when we're breaking out, like whatever the strategy is to do breakouts, how can I have the best possible entry? Where can I anticipate the price to go in order to get the best possible entry? And then that will reward you many times over in your trading performance. So that's all. That's great. Based on yesterday's call, whoever wants to send me their 20 last trades, I'll take a look at it for you. I would definitely encourage you to do that, because just by doing it, you will find, patterns, and you'll find clear, like things that are clear as day when you look at your past 20 trades, live trades, that you didn't think of when just by thinking about your last trades. But you will find hidden gems there that will instantaneously improve your trading. So yeah, I know Isaac sent me his, so that's great. I'll look it over now, and yeah, anyone else wants to do the work, go ahead and I'll take a look at it. Yeah, other than that, if you guys are watching on YouTube, make sure to first of all like and subscribe, and join the Discord, where all the indicators and everything that you see are in there. And yeah, that's it from my side. If you guys have any questions, just DM me, and I'll see you guys in the Discord.